The following is a presentation of TFNN. It is now time for the Tiger Technician Hour with your host, Basil Chapman. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, Basil Chapman.
Hi everyone, Basil Chapman, Tiger Technicians Hour, 11 o'clock till 12 Eastern Time, Monday through Friday and market days. Of course, we will not have a show on Monday, so have a great long weekend, have a great Valentine's. And it's good to be back in the chair, and thank you to Tom and Steve and John for 3 great hours. I hope I can add the 4th hour right here. And of course, we've got Nico and Paige coming straight after me. Now, before I forget, before I do anything else, let me just remind you that I have, in fact, a webinar coming up. This webinar is going to be this coming Thursday. In fact, a lead-in for those of us in the den, not listening in Tiger TV, but we were listening to a song from the very early 1930s, Anything Goes. And Anything Goes really represents a tremendous number of areas and aspects of the late 1920s, very beginning of the 1930s, that complement and really parallel a lot of what's going on now. But if you look at the mood of the country at this particular time and the euphoria in many areas, that was in music, in the arts, in the stock market going to all-time highs, and having just come through 15 years of war and the great flu epidemic of 1917s, and then of course in the mid 1920s there was the German debacle of the Deutsche Mark. Just you had to take a wheelbarrow for a slice of Deutsche Marks for a slice of bread, or at least a loaf of bread. And in the den, we've got, 1928 to 1929, the Dow doubled. So I'm going to be talking about the parallels, the complementary aspects, as well as what is not coinciding with the characteristics of that particular period. And one of the reasons why I think it is such an important period, and I said this when I set up the webinar for Thursday, February the 19th, I said both in timing for the webinar, as well as timing for the market, as well as timing for the relationship. I don't know right at that particular time whether it is a perfect time, but I'm waiting for about 7 out of 10 categories to be fulfilled or combined to be able to say, yes, we're getting a tremendous amount of similarities. And lo and behold, look at this chart that I'm showing right here. First let me just say, the webinar is Thursday, February the 19th, 6:30 to 7:30 p.m. Eastern Time for subscribers. It will be archived. Yes, questions in the den. I will be it will be archived, and I'll be doing it in such a format. There'll be a mix, as always. There'll be the fixed the template that I use is a fixed PowerPoint presentation. I cannot help it. Within it, I have to go to live charts. I have to show you the parallels of going into 1928 to 1929, where we are in the market, what coincides. Hey, what about bonds? What about yields? Were yields going down? Has it been an historic fact that most major turns in the market have been created when yields started to go up? What about this Japanization of bond yields that I've spoken about for 10, 15 years? Just a long, long time. The Japanization of our bond yields, U.S. bond yields, as they go down to almost zero. Well, we were almost there the other day. Now we're having a bit of a bounce. But I'm going to talk about the relationships. And what's really important about this particular webinar is that I get all the time, I get questions from either subscribers or just general tigers listening out there saying, hey, this is kind of intriguing. I want to know a little bit more about it. And they asked me a question about my portfolio. Is it time to get out of the market? And for up until now, I still have not said get out of the market. I still believe we're going to go to higher highs. I'm also anticipating, and that's why this chart that now I can go to. So go to the front page of TFNN, check it out. It's the easiest thing you can do is to sign up to be, for 1 month you'll get, it's very unusual, it's usually a 2-week free, but this is a 4 weeks for for people who subscribe for the trial, but you don't have to pay for it. It's just a trial. And you'll be able to go to the webinar. And it's really important to do it before Thursday night. Well, it'll be archived, yes. You can do it afterwards, but it's the impact of that moment that is really quite important. So 2 things to keep in mind. One is you can go to the front page. You'll have the whole weekend and early next week to sign up for it. It's really, I think it's going to be invaluable to your comfort factor. If you know someone, if you have a portfolio, if this is like one of those ads where they say, if you have $5 or if you owe $5 or more, you've got to, whatever it is. Well, this is not the same sort of thing in that I think that what I'm going to try to do, I'm not going to tell you that on August the 23rd of 2015 or February the 6th of 2016, it's all over and we're going down just like in 929. I'm not going to tell you that. I'm going to tell you what to look for. I'm going to tell you the signs. I'm going to tell you about the historic relevance of skyscrapers to major market tops, with the Petronas Towers in Malaysia, or 1929, the Empire State Building gets signed into commission so that the building starts almost immediately, right within weeks of the all-time high of the Dow at that particular time. I'm going to be talking about the relationship, the mood of the country. And that's the big thing that I can't, when you're in it, it's not always very easy to see. And that's one of the reasons why I've said to people who develop chart formations and all that, and then base a lot of the criteria they're looking at on the actual chart formation based on colorations and all sorts of ephemeral things. I say, no. It's the history of market moves. It's the chart patterns that you look at. It's not just one bar that is a particular formation. It is not one thing, criteria that makes market turns. It is many factors that come together. And that's why I always say when the Fed comes out with an announcement, don't think that you're going to get a major market turn. Yeah, maybe I could count on 3 fingers over 15 or 20 years how often you've got the Fed coming out with a statement that coincides exactly with the top that takes you 12 or 14% or more to the downside or even the upside. Trends stay in position for quite a long time until something happens, and it's usually a technical indication, a cumulative set of indicators that turn the markets around. And I'm going to be talking about that. I'm going to give you guidance just from my perspective on what I'm looking at. So with that said, sign up. I think you might enjoy it. Let's just run the numbers quickly. And I wanted to say, here's a chart that says that the weekly chart, finally, of the E-minis, of the S&P, I'll do it as we move along, but I just wanted to show it because it's kind of exciting. Whoops, right there. The S&P, the Dow has not done it, but the S&P has gone to leg C in the weekly charts, only leg B in the daily. And that's the 120-minute chart. Let me just move it down for a moment. Look at that. Because we've gone higher, I can put an F/B. And I think that has resolved a ton of stuff for us. Why? Because my eye, based on all the technical indicators, says there is a much greater likelihood that we are in leg B in the Dow than leg F. It was F. This could be the very serious top coming up. I just don't think this is going to be it. I think that there's more to go. But I'm also suggesting that March could see a really sharp pullback. We could give back a chunk of all those gains that we made. This is the candle of February. In February. Isn't that interesting? So let's go through the numbers. The Dow is up 48 at 18,020. The S&P is up 5.5 at 2,094. The composite index is up 16 at 48.73. Let's just go to the gold. Gold is up 11 at 12.32. I'm going to do gold in a moment because I had a couple of questions while I was away, and I do want to get to it. Silver is up 60 cents at 17.40. Platinum's up 11 at 12.10. High-grade copper is up 45 cents at 260.7. Wow, it's had a tough time. Crude oil is now up 2 at 53.31. Bonds are down 30 seconds at 128.10. Whoops, that's a mistake. Down 20 at 146.06. That was the 10-year yield. And the dollar is down 5 cents at 94.14. And we've got the euro slightly up and the Great British Pound slightly higher. And I want to go straight away to a couple of things because we're going to go to a break very shortly. And I wanted to show you my thinking here. The MDY, which is the mid-cap S&P 400, I believe it is up at 272.96. This is probably a brand new leg B that I'm looking at in the daily chart. It might be an F/B. At this point, I'm just calling it a B because I think it's just very, very strong. 91% in the stochastic. MACD is good. The weekly chart has got 80%. The MACD is good. Leg C up. And the monthly chart, I say that I believe that it's a B and not a G. In a sense, this is just the middle of the month. I don't want to say it's been confirmed. The monthly chart needs to hold very well, and let's just leave it at that. But it is looking very strong. Now, here is the real issue. You've got the QQQ series. I love the action, the way it broke out above 104.58. It did it so superbly, but we've got gaps. On yesterday's move was a gap. We almost got a gap the day before on Wednesday, but we've got a gap Thursday. We've got a gap today. I'm not sure by the end of the day we're going to fill the gap, but it looks to me like this. If this is a brand new leg B in the QQQ series, trading 106.44, that portends higher prices. And let me put it into time. That means that Tuesday, I'm not even sure what the date is. I wonder if I did this, am I going to mess things up? No, that's good. So Tuesday will be the 17th. I believe that we cannot make a high if Tuesday is an immediate down day with no new high, making today's high a peak B in the QQQ series. We could not get leg D until Wednesday could be the move up. Thursday, that would be C. Thursday could be the move down. That would be peak C. Friday could be the move up. So it wouldn't be until the following week Monday, that we could even get a peak D in the daily chart of the QQQ series. But this breakout has a characteristic here that I'm going to have to put E/B in the weekly chart. I'm going to have to put leg C, G/C, but everything about it says it's more likely C in the monthly. I have to tell you that this is quite remarkable. The breakout over the last couple of days in the S&P makes this a potential for a larger move up in 2050.
Today, it's hard to tell if the economy is coming or going. Regardless, I want my money going in the direction I choose. If that's your stance as well, then you want to know how Everbank can help keep your money thriving just the way you want. Is growing your money a priority? Everbank is committed to a yield pledge promise to pay high yields on your checking, money market, and CD balances. Looking to diversify? Everbank ingeniously developed accessible ways to spread your money around the world into foreign currencies and even non-FDIC insured metals. And when it comes to your wealth, they bring a highly experienced and global perspective to help you manage it. Everbank's financial philosophy flies in the face of the status quo. They believe your money's performance should not be determined by today's economic circumstances, but by the drive to rise above them and create opportunities that favor your objectives. If that excites you, like it does me, call 1-855-750-4051 to find out what they can do for you. That's 1-855-750-4051. Call them today. Everbank is a member FDIC and equal housing lender.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman wave sequence. Using the Chapman wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN and you'll find the Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
Check out the new look of Tiger TV. Now you can see all hosts, charts, and computer screens live in high definition. Whether it's Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, David White, Larry Pezzamento, Andy Hecht, Thinkorswim, or Daryl Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV. Now, crystal clear in high definition, 24 hours a day, 7 days a week. If you haven't seen the new look of Tiger TV, then visit TFNN.com. Basil takes your phone calls. Now, toll free at 1-877-927-6648. Internationally at 727-445-1044.
Hi, folks. We're back, and let me just finish this chart here with the Chapman wave notation. Yeah, I believe that this is a leg B in the 120-minute chart, maybe E/B. So far, everything about it looks like it's a B. The daily is in a C, and the composite index is up 15 at 4,872. It's in leg C. It broke out to leg C in the weekly, and the monthly, I've got F/B, and my preference very soon is going to have to switch it around to a B/F because it is really acting very well. You keep getting an F in the weekly. I'm not sure. Okay. Let me go through this. If you take the low that was made right here, I think that's the most obvious low. And this is A, B, C, D. And that became a peak D, beautiful peak D right there on the week of the 19th of September, question in the den. On the 19th of week of the 19th of September of last year at 46.10, it pulls back sharply to 4,116. Week of the 17th of October, that was the 15th low. And then it goes peak A, E/A, F/B. Stochastic and MACD start to turn down sharply. Price holds beautifully with a higher low bar right there. The week of the 16th of January, higher than the week of the 19th of December. And now you've got yourself into a leg G/C, but everything about it, I'm not even going to do it. I'm calling it C unless I'm wrong, and it'll be proved wrong with a close below 4,700 in the next 2 weeks or so. So I hope that resolves that. Okay, you got it. Okay. No, it's not that I'm right. It's just that's my interpretation, and since I'm the inventor of the Chapman wave bi-mode notation, I have just a little leeway in interpretation. That doesn't make me right, just a little leeway in interpretation. So Now, there were a couple of questions. So that I did the MDY, I did the composite index. Someone had asked a question earlier. Basil, how was the plane ride? Oh, plane ride was good. It was everything went really smooth. I even had a seat next to me free, going there and coming back. That was nice, and it was a very smooth ride. No problems at all. It just JetBlue did their very best, and they were good. Always a humorous pilot on the way. Let me just quickly check. Okay, there were questions there. And okay, now another question was on gold. I'm going to do that right now because this is Technical Friday. And don't forget, folks, we are closed Monday. So you have 3 days in which to look over the webinar that I'm giving Thursday, how to sign up for it, etc., and it will be archived. Let's see, in the den, Mr. Bull says, old Basil saying, if the count is weird, you probably counted wrong. I found this to be true for me all too often. Yes, it's very interesting. And then what I always say also is that if you're having trouble with the wave count, as long as the technicals are good and as long as the price is acting well, you only have to wait for the next peak and high bar or trough and low bar to be able to probably get it right. And if you're in a bull mode or a bear mode, you don't even have to really do anything because the tide is the most important thing. It gives you a little time. So, it would be wonderful to have this. I've worked with so many software people in trying to get it right. There are human questions, things that my eye will pick up within just like a split second that I just know the computer won't. And then if you start to form fit for the computer, in other words, if you start to make adjustments in the software program to take in one particular aberration, one particular unusual thing, it impacts everything else. So I'm sort of avoiding it, but actually over the next few months, I'm going to get deeply into the programming of the Chapman wave. But in the meantime, back at the ranch, we've got the comp index still acting very well. Now we're going to go to gold. I'm going to go to the, I think he wanted me to go to the G contract. I'm going to do that, but I'm going to prefer, just real quickly, gold right now is up 1270 at 1232. It's coming off a low that was made yesterday of 1217, having hit 1307 back in the 22nd of January. So that's quite a deep retracement. Now you can affect, this is the period where you should get some kind of a counter trend rally. I call it counter trend only because it has to go all the way back to 1308 or 1307, say 50, to start leg D. It could even have an inside buy mode here with the peak A, gray peak A, gray peak B, gray peak C, and then boom, right through for leg D, reactivating that old peak C. But I'm going to do this. I'm going to, if you don't mind, let me see, who was it? Dwayne, if you don't mind, I know you asked for specifics on the contract, so I've got the continuous contract, and what contract is this? This is February? Yep, February contract. Hey, why am I looking at the February contract? Surely February is just too soon. It should be, what are people looking at here? I'll go to them if it's possible. I'll be right back. Basil Chapman, Tiger Technicians Hour, looking at gold. We'll be back.
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com. Trade with confidence and clarity while using the software that thousands of institutional traders rely on to make the best and most accurate decisions. Choose from 1,000 equities, currencies, and futures instruments utilizing the TAS architecture. As seen on Bloomberg terminals worldwide, the TAS Profile Scanner is a benchmark technical filtering system that thousands of traders rely on, and now you can too. For a limited time for TFNN subscribers only, we've reduced the price to just $97. That's over 75% off. John Logan hosted a special subscriber-only webinar in December, and you'll gain access to that archive as well, so you can learn exactly what the TAS Profile Scanner can do for you. Try this product out. No matter what you trade, the TAS Profile Scanner can help you make more informed trading decisions. There's no obligation to pay anything. Don't let this offer pass you by. Get your 30-day free trial to the TAS Profile Scanner today by signing up at TFNN.com.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads.
You know what's cool? Taking something that's good for you. Something specifically formulated to help with weight loss, better sleep, stress reduction, and the need to detox.
Nico, our hunter and gatherer ancestors found all their nutritional requirements for health in their wild environment. But today, our food sources no longer contain the vitamins, minerals, and nutrients our bodies need to stay healthy and strong.
That's why we need Primal Edge Daily Nutrition. It includes a special blend of ionic, soil-based vitamins, minerals, fatty, and amino acids in an easy-to-use liquid form.
Primal Edge is powered by highly concentrated fulvic and humic acids, nature's preferred delivery system. They have been called miracle molecules because, like sunlight, air, and water, life cannot exist without them.
That's right, Paige. They ensure we receive all the nutrition we need to be healthy and thrive. We take it every morning.
Primal Edge, formulated and approved by Nico and Paige of Living a Primal Lifestyle. Buy it today for just $89. Click on the Primal Edge banner on the front page of TFNN.com. This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Hi, folks. We are back, and the Dow is up 41, S&P's up 5, and we've got Pat in Dennis, Massachusetts. Hi, Pat. How are you?
Hi. How you doing, Basil?
I'm doing well. I'm going to ask you one quick thing, just like if you can, I know you've held on, but if you can hold on one moment, I just want to do these things because if I don't do them, I'll run out of time, which would be a shame. And then I can at least spend a lot of time with your question because it's a great question. So Apple for Ignacio. Apple is in leg E in the monthly chart, D in the weekly chart, and a peak E is possibly forming right here short term for a little bit of a pullback in the daily chart. That's that. And then the other question was, with Dwayne, I'm going to spend a little time just before the end of the show on gold. And there was another question that I was just going to deal with. Doesn't matter. I forgot it already. Wow, that was quick for my memory. But Pat, you got a question? Yes.
Yes. You know the 43-month chart you've been showing with the two A to Ds. Now the first one you're measuring. From the first A to D, you're measuring from the low to the high. Is that correct?
So let me just pull this chart right across here so that on Tiger TV, everybody can see exactly what you got that you're questioning, or at least you're talking about. The high that was made at 14,000 in the Dow, at 14,198, October of 2007, was a doji candle peak F, the sixth highest peak in the Chapman wave.
Oh, F, okay.
Then it came down in 5 troughs to trough E, And that was the low of March of 2009 at 64.69. Remember, March the 6th of 2009, I got a buy signal right within a point of the low. I think it was about a point of the low in the Dow Diamonds on the very day of the low. And that went all the way to peak A, B, C, and then D on the week. That was in May of 2011 at 12,876. And what did that do? I didn't notice this until a while back when I was doing some work, and I said, wait a minute. It took 43 months to go from the October 2007 low, a high, to the March 2000 low, then to peak D, the most significant pullback we've had in all this time in the 6 years of the bull market, almost 6 years. And from May of 2011 at 12,876, that was the 43rd month. And then what did we do? We pulled back to 10,404 to the October. Once again, it's in October. We got these October and sort of March, April, May, early springish periods. And what happened was in October of 2004 was the low. 2011 was the low at 10,404. Then it started a move that went peak A, B, C, and it went to peak D in December of 2013 at 16,588. But that held the 9-period moving average barely pulling back, and it continued higher. And even the October 2014 low of 15,855 didn't change anything, because the very next month, that month and the next month, were making new all-time highs. And then you went to this candle, very important candle, which was not a little bit longer, but not dissimilar to the top that was made at peak F in 2007. And that made it very important. Why? Because for the whole, that was December, and it was the 43rd month, and we went to 18,103. That made the decline in January very important for two reasons. One is we started to once again test, and it looked like on a closing basis, the 9-period moving average. That's number one. And number two, it made February really important, because if there was a decisive close under the 9 EMA, which is at 17,313 right now, so in the entire month of February, if instead of making a new high, we went down to another low, lower than December's low, and then close there, that would say, hey, be very careful, because you've got the 43-month time match to a potential top. You're starting to see the long-term monthly chart. You see the technical start declining, and the price is going to possibly close below the 9-period moving average. That says you need to see a new recovery high of 18,104. Well, technically it'd be 18,103.46, 1 penny higher, and that would take you to a new high. Well, two things. One is when you go very quickly to a new high from peak C to D, you got to be very careful, especially if it occurs within 1 or 2 bars, in this case months. But if you do it at peak E to F, and there's a chance that you've recycled, that could turn out to be very positive, because you could perhaps have reestablished the buy mode, and that's very important. And that makes that makes all of February important, because it's just going to take, even if it's the last day of February, and we go to 18,104, it says now there's a chance, because of the technicals holding quite well. The stochastic still at 88%. The MACD is quite good. That you've recycled, and instead of this being a very serious move of 15% or more, let's say, we might get that big percentage move, but it's now within the context of a possible buy mode, and it says that there's a good chance that if you did have a sharp pullback, that you will not break the 15,855 low of October, number one, and there's a good chance that you won't break more than about a 50% from whatever the high is in February to whatever the pullback is based on the 15,855 low of October. So in a sense, I'm trying to give you what I'm looking at. I don't know, does that make sense?
Yeah, it does make sense. I was wondering if you had also, I haven't done the work myself, I'm going to do it though, but I wonder if you'd also looked at it in that maybe you have an A, B, C, D up. In other words, start with the low point, go to the first D, and then start with the low point in 2011 and then go up and put a Fibonacci extension on it.
Yes, I've done that a number of times in all different ways. But the move from 64.69 to 12,876 was just under 6,000. Well, let me just do it right now. 664. Right. So it was just under 6,400 points. So it did a just over, I think it was just over 100% gain. If you come back to 10,404 and you add that 6,400, you're already way above that. You're at 18,103. So in Fibonacci terms, I would rather look at it in the extension, the Fibonacci extension, than the usual 1-to-1. And I would not go all the way to D. I can do that now, and I'll tell you what we get. We get somewhere around 19,146 would be a 138% gain. Normally, I would not do that. I would take it to the high. If I can find the thing, it just disappeared. Right there to there. If I could find, yep, it goes to there, and I pull back to there. Let me explain what I just did. I went to peak B, which is in April of 2010. You got that, what was it, 12%, I think, pullback. And from the low of 96.14 in July of 2010, I give that an expansion, and that expansion goes to a 200% expansion at 18,740, and the 161 is at 16,900. So we're sort of in between there. So all I can say is that I'm excluding all the work I've done with Fibonacci expansion and all the 1-to-1s, etc. I'm setting them aside, and I'm saying, you know what? I want to stick first with the time, the 43-month time cycle. And since the S&P and the MDY, the 400 S&P mid-caps, have already gone to all-time highs, it says to me, and the QQQ series is getting closer and closer to the 120 all-time high, it seems to me just a logical conclusion, without getting too carried away mathematically or anything, to suggest that there's a very good chance that 18,103 will be pierced. We're only 100 points, less than 100 points away at this particular stage. Got an entire month to get there. And when you have a very quick, for certainly when you've broken the 43-month time match, it means that one factor that could be a big negative has been, at least it seems to be, alleviated. And now I've got to say, have we recycled? And the evidence based on the rotation in the market that we've gone to cyclicals, even U.S. steel is starting to act well, says to me that there's still life in this bull market, and that we're actually looking at distribution in some sectors like utilities and others that have had spectacular moves. Also, you've got bonds that are... I'm trying to be as optimistic as possible, but it is a potential peak E in the monthly chart of my bond continuous contract, 15128. Yep, by 5 seconds, but so far that's working. And it says to me there's a good chance that we're going to get some kind of a sharp pullback in February, which will retain this U.S. imitation of the Japanese bond yield going down to almost nothing, giving virtually no percentage return. And that says you could have a little bit of a bounce in here, but that bonds are possibly now in the upper range, and that if they do go higher, it's just going to be slow moves to the upside with a containment area that I think is going to, at least for about 6 months or so, 8 months, going to be like a rectangle formation rather than inverted V, or even a cup formation. I don't know. That's my thinking right now. And if that's the case, and that's what I'm going to be talking about this coming Thursday night, is there a chance that money will migrate from the so-called safety of bonds into the stock market? Because we have not yet got anything. I'm not even talking about the year 2000. I'm talking about going to early 1929. From all that I've read, we haven't gotten even close to a period of any kind of hysteria in the stock market, or even in one sector. Invariably every year or two, there's one of the sectors that just is, whether it's 3D imaging, there's always, like iOmega back in the 1980s, I think it was. There's always something that is the sexy area, or Tesla. You get an individual stock or two, but there's nobody when I go anywhere, nobody's talking about stocks at all. And except for the people that have always talked about stocks. So those friends of mine that whenever we've got together for years, decades, talk about stocks, we still talk about stocks. But I don't have fresh people coming up and say, I have occasional, but not really. I don't have fresh people. And that says to me, I must not be too anxious to make an exact parallel in the time match of 28-29. But the time match is going to be an emotional match, and I don't think we've gotten even close to that. But if you look at statistics, you'll see that more and more people are, in fact, putting money into the stock market because it keeps going higher, and that seems to be the obvious place to put money if you want some kind of a return. But we haven't yet got anything of that emotional hysteria that we usually see. So my thinking right now is that there could be a couple of real sharp sell-offs coming within the next month or two, but the main trend of higher highs and higher lows, I think, is still intact.
Yeah, I agree with you. I see a lot of money I think a lot of money must be coming over from Europe, where Europe has taken a dive, and they're probably getting out of the ruble, and people are moving money out of Greece. And, where are they going to put it?
I never even discussed that aspect because I've spoken about it before, but this morning I completely forgot about that aspect. I've spoken about it often enough, but it just was off my radar. But I mean, Japan has said we're taking money and we're buying stocks. Where are we going to buy stocks? They didn't say it. They're going to buy stocks in the market that's moved the very best, and that's the United States. You've got that all over, and when it's like the currency, it's like the dollar. When you get major buying pressure from not human beings, but countries, of course they are managed by human beings, but I'm talking about major money, it really gives a kind of a cushion. Now, the big thing is when that starts to fail, and it's going to, sure as I'm sitting here, it's going to fail at some point. What happens then? That's the perspective that I want to be able to at least touch on and give a sense of what could happen, what could go right and what could go wrong. I think that's really what I know. I want to clarify for myself, and I hope I can clarify it for people. But someone has said very, very succinctly and very cleverly, I thought, when the market feels that money is going to come out of bonds, it might not move as slowly as the Fed thinks. Very perceptive, very clever, because once they smell blood in the water, these sharks are going to act, and that means I got to watch bonds real closely.
Yeah, I've been watching them too, and the 10-year yield has gone up, and the yield curve between the 30 and the 5-year keeps creeping down.
Let me show you something. Oh, we've got a break. If you can hold on, I'm going to show something in the real estate market and in wood, which is the iShares Global Timber and Forestry ETF. I'll be right back. We'll be back with Pat in Dennis, Cape Cod, Massachusetts.
You take a hands-on approach to managing your investments, and whether you're bullish or bearish on U.S. Treasuries, the ETFs from Direction Shares are there to help you magnify your perspective. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at directionshares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foreside Fund Services, LLC.
We're told to follow our passion and everything else will fall into place. I hope that's what each of you are doing each and every day. Hi, I'm Steve Rhodes, host of the Money Master Show at TFNN.com, and my passion for technical analysis is what led me to the most fundamental discovery in pattern recognition, the Rhodes Momentum Indicator, market scanner, and trading strategy, a set of tools that identify the momentum and power of the trend, the likes of which have never been seen before, for every market and every time frame. Yes, folks, the trend is your friend, unless you're on the other side. New to technical analysis? This is the place to start. And experienced traders, take advantage of the trend like never before. Experience the power of the Rhodes Momentum Indicator each day, available to subscribers of my newsletter service, Mastering Probability. I guarantee your satisfaction for the next 30 days unconditionally, so there's no risk to you other than being on the wrong side of the trend. Mastering Probability, available on the homepage of TFNN.com. And folks, live with passion.
In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. The Art of Timing the Trade Charts has officially launched at TFNN. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind software, The Art of Timing the Trade Charts allows you to scan for Fibonacci formation setups, including Gartleys, butterflies, ABCs, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the market for stocks just beginning to form the trading patterns that many investors spend days, weeks, and even months searching to find. As part of our introductory pricing, we're offering licenses available at only $59 per month. We're so confident that you'll love this new outstanding piece of charting software that we'll even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Lock in your low price today by ordering your copy at TFNN.com.
Learn about good health and fitness. Living a primal lifestyle with Nico and Paige. Next on TFNN.
Hi, folks. We're back. We're back with Pat and Dennis, and we're looking at the Dow up 41, the S&P's up 530. I just want to do two things as we're going back to Pat. One is this dashed line here. This pink dashed line has been the resistance line. The Dow, I had to change it from one level to another, but today it hit exactly and it's pulling back, and that tells me that this line is now an important line because it's matching and hitting. So the Dow could have a little bit of a pullback as we go into the close, a little nervousness over the long weekend, etc. But this is really terrific action, number one. And number two is the question I want to know about WLL, Whiting Petroleum, is trading at $37.93, up $1.81. I want to know what's the support. The support is above the low of the 11th of 32.86. I would put that support as quite important at about 35.22. It's at 37.95 right now. If it goes over 40.23, that's leg F/A, and we'll see what happens at that point. But that really makes the weekly chart improve, as we had discussed when you called me. Now let's go right back to Pat. So Pat, this is something that I think is important, is that looking at the markets, both the IWM and the Dow Diamonds, which were very important components that I was looking at, have made leg D. So D in the IWM and in the weekly chart, and the daily chart is in leg E, and the Dow Diamonds have actually gone to an all-time high, and that makes it leg C. So we've got so many parallels in the chart formations at this particular point that it says the Dow should be dragged higher, and that's going to be really important. And it's great that this week it's not doing that, because it means that next week the Dow is at peak C, and all the others that I'm talking about are in leg C. So now you're getting some kind of important rotation that says we've got a coincident factor here that's very important, number one. And number two is that I wanted to mention to you this the iShares Global Timber and Forestry ETF has gone all the way to a leg D. This is a weekly chart. It's stopping right here at resistance, but it's great that it had a spectacular week this week, and it's great that it's in leg D, but it is a weekly chart. And the HGX, which is the real estate, the Philadelphia housing sector index, is in leg D as well, and they've been matching and doing beautifully together. I haven't got a trend line here at this particular point, but I have got it for the wood is the symbol for the iShares Global Timber and Forestry. So what that says is that there is enough evidence here to suggest nominal new highs in February, and that some of these indexes that are coinciding in leg D, if at the end of, close to the end of February, I'm starting to see weakness, then we could get the pullback. And that pullback to me is going to be the determinant, the price movement of where there's a bottom coming, and the duration, the time, the duration, the quality, and the rotational aspect of the sectors that were really strong. If they start to fall or they don't rally very well, they would say to me that we've got yet another rotational aspect to this market, and that rotational aspect is going to probably contain some of the sectors that were so poor before, like the financials, like the autos. It's going to be really interesting. So I thought I just wanted to cover that, just because your question basically was the implication. Gosh, what could actually now push the market higher if there's this 43-month relationship, which appeared to be potentially important? How would it be undone? And it would be undone if February into March starts to create a wide range between highs and lows. So I hope that helps you, Pat.
Yes, very interesting conversation. Thank you, Basil.
And thank you so much for calling and bringing it up, giving me a chance to talk about it. Folks, stay tuned. You've got Nico and Paige, great program all day. Check my webinar right here. It's coming up on Thursday a week. Go to the front page of TFNN. I'll be back.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
This is TFNN.